When's the last time you realized it was important to switch up your habits in who you did business with? Now, I mean anywhere as simple as going to a new restaurant or changing cell phone providers, and either you got a lot more happiness from finally making that switch, or you saved a lot of money. Mortgages are no different. If you're about to get your mortgage renewed, let's say with a bank, and it seems like the easy thing to do, in this video we're going to talk about why you should look at other options, because when it's time for renewal, there are a lot of lenders that are fighting for your business, giving you competitive rates, and in the most basic of examples, you could be saving $7,000 just for putting in a little bit of time. If you got your mortgage close to 5 years ago and you're on a 5-year fixed term, you're about to come up for renewal. Now, the greatest thing about this is that it's a golden opportunity for you as a free agent to go shop around, because lenders are really vying for business nowadays. And again, this is a perfect chance for you to see what else is out there so that you can save money. For all the Raptors fans out there, I'm going to use Kawhi Leonard as an example. As many of us know, he helped Canada finally win its first NBA championship in 2019. Now, when he was a free agent that summer, he had all the leverage in the world. Everybody wanted his business. And you should think of yourself as well as a Kawhi Leonard, because you're now a free agent and people want to work with you. A mortgage transfer. What is it? Okay, so you have lender A that you owe a bunch of money to, right? That's your current mortgage. They will sell it to a new lender, hopefully the lender who's charging you a much better interest rate. And basically what happens is that all those IOU slips, they're now with the new lender. And that's basically how it works. It's different from a refinance. With a refinance, usually you're changing the structure of the mortgage. So you're changing who's on title, how it's registered, or you're usually pulling out equity. Now, how do you make this decision properly? Of course, there will be some kind of cost. Besides your time, of course, there are the costs of this. Okay, so depending on how your mortgage was registered, you're looking at between $200 to $1,000. You may or may not have to have legal fees included. Again, it depends on how your mortgage was structured, but really, it's not a lot of money for how much you can actually save from this process. Now, if your mortgage term is not over, look, in some cases, it actually is still worth it to break it early, because you still save more than you're spending to break it. So when you break it, whether it's fixed or variable, you're gonna pay 3 months worth of interest rate charges, or if it's a fixed mortgage that you're breaking, it's gonna be the higher of your monthly interest rate charges, or something called interest rate differential, that's IRD. And if you really wanna know how that all works, just use Google or talk to your mortgage broker friends, and you'll see exactly how it's all broken down. In this example, we're gonna look at what's, let's say, a $500,000 mortgage, and we're gonna look at what the average mortgage terms were, or the interest rates 5 years ago, and compare that to what they are today at the lowest amount that we can get, and you'll see very quickly how you can save $7,000. The average mortgage interest rates from 5 years ago were about 2.6%. Now, at today's lowest rate that we can get is 2.29%. We're looking at 0.31 percentage difference, and across 5 years, we're gonna show exactly how that gets you to saving $7,000. Well, let's plug it into our handy mortgage calculator. So we have a $500,000 mortgage, and we're looking at what the interest rates were 5 years ago, which is 2.6%. If you look at from day 1 to the end of year 5, the total interest charges are just under $60,000. Now, if you switch to 2.29%, over the next 5 years on a $500,000 mortgage, you're only looking at about $52,600-ish across the next 5 years. Now, if you just subtract what you would be paying on the 2.6% rate with the 2.29, you'll see that you're saving just over $7,000. Now that is pretty awesome. So now you have $7,000 extra dollars in your pocket. How are you gonna be a smart investor and use that in the most productive way that gives you happiness? Do you put $7,000 in an index fund and just see it grow through the stock market? Or do you put that into a TFSA account so that when you apply for your next property, you can pull out that money for your deposit tax-free? Those are some great options if you want to think like an investor. Or you go another route. You spend it on amazing ingredients for cooking at home, going to some nice restaurants, living your best life and traveling. Whatever it is that you do with the $7,000, you have so much more you can do to really level up your life. What's your next step? Okay, so talk to your mortgage broker and just do the math. It will almost always be worth it to make the switch and the transfer. Remember, it's a very marginal cost to do it. And in some cases, you may not even be at renewal, but it's still worth breaking it early because the math works out in your favor. Do you have a question or opinion on this? Please leave a comment. I do read and reply to them all. And if you have a friend who is a few years into their mortgage and could potentially save some money, make sure you flip them over this video and also make sure that they include you in those $7,000 of extra budget. If you learned something today or think that an extra $7,000 in your pocket can elevate your life, please subscribe and of course be alerted for the next video. And as always, friends, keep leveling up your life.